Did BlackRock just kill Bitcoin? By the end of this video, you will understand why a $100 billion inflow actually decreased Bitcoin's potential returns by 65%. That sounds backwards. More money equals lower returns? How does that work? The answer involves math that Wall Street understands, but retail investors completely missed. And once you see it, you will never look at Bitcoin the same way. Because here is what nobody is talking about. The same institutions that pumped over $100 billion into Bitcoin ETFs in less than 2 years just fundamentally changed how Bitcoin moves, not through manipulation, not through conspiracy, through something way simpler and way more permanent: physics. When you inject $100 billion of institutional capital into an asset, you do not just change the price, you change how that asset behaves, you change its DNA. And Bitcoin investors who remember 2017 and 2021 built their entire strategy around one thing: extreme volatility, wild swings, 10 times, 20 times, 50 times, gains in months. But here is the problem. You cannot have institutional legitimacy and 10 times volatility. Wall Street forces you to pick one, and Wall Street picked legitimacy, which means the era of Bitcoin going from 10,000 to 60,000 in 18 months, that is over. Not because BlackRock is evil, not because institutions are manipulating markets, but because when you add 100 billion in stable capital to a volatile asset, basic math takes over. The asset becomes less volatile, and less volatile means less upside, period. Welcome to institutional Bitcoin. It is legitimate, it is liquid, it is boring, and those 100 times gains everyone is waiting for, they got ETF'd out of existence. So to understand exactly how this happened and why traders who made millions on wild swings are now stuck watching paint dry, we need someone who watched this transformation happen in real time, someone who lost money learning it. Meet Ryan Torres, fictional character based on real trading patterns from real traders who tried fighting institutional Bitcoin with retail strategies. 36 years old, volatility trader at a mid-sized hedge fund, 12 billion assets under management. Ryan's entire career is built on one thing: finding assets with high volatility and extracting premium from it. For 8 years, Ryan made money trading options on tech stocks: Nvidia, Tesla, AMD, anything with big price swings. His strategy is simple. When volatility is high, sell options and collect premium. When volatility crashes, buy options cheap and wait for the next explosion. It is not sexy, it is math, and Ryan is very good at math. Over the next 20 minutes, you will watch Ryan discover why the better Bitcoin performs, the worse it becomes for volatility traders. He will lose $170,000, learning a lesson that will change how you think about Bitcoin forever. But before we see what Ryan discovered, smash that subscribe button and drop a comment with 2 words. Either bring institutions if you think legitimacy is worth sacrificing volatility, or keep it wild if you think Bitcoin should stay a speculative moonshot. I genuinely want to know where you land. Bring institutions or keep it wild. Comment now. All right, back to Ryan and the model that predicted everything. December 2023. Ryan is having coffee with his boss when she asks the question that changes everything. What do you think about Bitcoin? Ryan almost laughs. Crypto? We do not touch that. Too volatile. Compliance would freak out. But what if it was not crypto anymore? What if it was just another asset class? She shows him Bloomberg. SEC expected to approve spot Bitcoin ETFs January 2024. BlackRock, Fidelity, ARK. They are all filing. If SEC approves, Bitcoin becomes accessible through normal brokerage accounts. No exchanges, no wallets, just ticker symbol. Ryan stares at the screen. If Bitcoin gets ETFs, institutions will allocate. And if institutions allocate, volatility changes. She nods. I want you to model what happens to Bitcoin volatility if we see 30 to 50 billion in institutional inflows over 12 months. When do you need this? Yesterday. Ryan spent 72 hours building a model he would reference for the next 2 years. First, he pulled historical volatility data for every major asset class. He needed context. How does Bitcoin's volatility compare to everything else institutions trade? S&P 500, annualized volatility 15 to 20%. Boring, stable. What pension funds want? Gold, 12 to 18%, even more boring. Nvidia, 45 to 60% during growth phases. High but manageable for a $1 trillion company. Tesla, 50 to 70% during Elon's Twitter years. Insane for a large cap, but Tesla had institutional holders managing the risk. Bitcoin from 2020 to 2021, 80 to 120%. Ryan stopped. 120% annualized volatility. That means Bitcoin regularly swung 30 to 50% in a single month, March 2020. Bitcoin crashed from 9,000 to 3,800 in 48 hours, minus 60%. February 2021, Bitcoin went from 29,000 to 58,000 in 3 weeks, plus 100%. November 2021 to November 2022, Bitcoin fell from 69,000 to 15,500, minus 77%. No pension fund on earth allocates to an asset with 100% annualized volatility. That is not investing. That is gambling. But Ryan realized something crucial. Bitcoin's volatility was not a feature of Bitcoin itself. It was a feature of its market structure. Small market cap plus low liquidity plus retail dominated equals extreme volatility. Bitcoin's market cap in January 2024 was 800 billion. Sounds big, but compare to Apple at 3 trillion, Microsoft at 3 trillion, Nvidia at 2 trillion, gold at 14 trillion. That is 17 times Bitcoin's size, 17 times more capital required to move the same percentage. And small market cap means small amounts of capital create massive price moves. Here's the key insight. $10 billion flowing into Bitcoin with 800 billion market cap equals 1.25% of total market cap. 10 billion flowing into gold with 14 trillion market cap equals 0.07% of total market cap. Same dollar amount. 18 times bigger impact on Bitcoin than gold. This is not theory, this is basic arithmetic. Ryan built 3 scenarios. Scenario A, no ETF approval. Bitcoin stays retail dominated, market cap 800 billion, volatility 80 to 120%. 10 billion inflow creates 12 to 15% price move. Scenario B, ETF approval. 50 billion institutional inflows over 18 months. Market cap grows to 1.5 trillion. Volatility compresses to 40 to 55%. 10 billion inflow now creates only 6 to 8% price move. Scenario C, 100 billion inflows over 2 years. Market cap hits 2 trillion. Volatility drops to 35 to 45%. 10 billion inflow creates just 4 to 6% price move. Ryan stared at his model. The same $10 billion, 3 completely different impacts. Not because Bitcoin changed, because the structure around Bitcoin changed. Bigger market cap equals harder to move. More liquidity equals smaller swings. Institutional holders equals less panic. Translation, Bitcoin would become normal. Ryan titled his analysis, The Volatility Paradox: Why Institutional Adoption Kills. Bitcoin's upside, here's the paradox. Retail investors want institutions to adopt Bitcoin to drive price higher. And institutions will adopt Bitcoin. And institutional capital will drive price higher. But institutional capital will also compress volatility by 50 to 70%. And lower volatility mathematically guarantees lower percentage gains. Example, Bitcoin going from 10,000 to 60,000 equals 500% gain. That happened in 2020 to 2021 with 120% volatility. For Bitcoin to deliver another 500% gain from 100,000 to 600,000 with 40% volatility would require trillions in sustained inflows over years, not months, years. More realistic scenario. Bitcoin goes from 100,000 to 250,000 over 3 to 5 years. 150% gain, still excellent, but not moonshot. The math is brutal and unavoidable. You cannot have institutional capital for legitimacy and wild volatility for 10 times gains. You must pick one. Ryan emailed the analysis to his boss. She replied in 3 minutes, "This is excellent. Build a strategy assuming 50% volatility becomes the new normal. We are going in." Ryan felt realization wash over him. He was about to help kill the thing that made Bitcoin interesting. January 10th, 2024, SEC approves Bitcoin ETFs, 11 ETFs approved simultaneously. BlackRock, Fidelity, ARK, Grayscale, everyone. First day of trading. $4 billion flooded into Bitcoin ETFs in 24 hours. Bitcoin price went from 46,000 to 47,300. 3% move. Ryan wrote in his journal, 4 billion inflow equals 3% price move. In 2021 market structure, 4 billion would have spiked Bitcoin 15 to 20%. First data point, model validating. Over the next 18 months, Ryan watched his model validate with terrifying precision. BlackRock's IBIT became the fastest growing ETF in history. Over 60 billion in inflows in less than 2 years. Total Bitcoin ETF holdings exceeded 1.3 million BTC, 6.7% of Bitcoin's total supply. Bitcoin's market cap grew from 800 billion to over 1.7 trillion. But here is what shocked Ryan. Bitcoin's volatility collapsed exactly as predicted. 2020 to 2021, Bitcoin volatility 80 to 120%. 2024, volatility fell to 45 to 60%. 2025, volatility hit 35 to 50%. By late 2024, Bitcoin's volatility had dropped below Nvidia's. An asset famous for 77% crashes now had lower volatility than a tech stock in an AI hype cycle. Ryan watched the transformation unfold in 3 distinct phases. Phase 1, the institutional break. February 2024 brought $10 billion in cumulative ETF inflows. Bitcoin climbed from 46,000 to 52,000, 13%. Solid, but not explosive. March. Bitcoin attempted breakout, 52,000 to 60,000 in 8 days. Classic retail FOMO setup. But at 60,000, a wall appeared. Price stalled, pulled back to 56,000. Ryan dug into order flow data and found something fascinating. Massive sell pressure at resistance, but not from retail panic, from institutional rebalancing. Here is what was happening. Pension funds and family offices allocated 1 to 2% to Bitcoin. When Bitcoin rallied 15 to 20%, they hit rebalancing triggers, automatic sell orders to bring allocation back to target. It is not emotional, it is algorithmic. Fund policy says Bitcoin allocation shall not exceed 2%. Bitcoin rallies to 2.3%, automatic sell, back to 2%. Every rally triggered institutional profit taking. Every dip triggered institutional buying to rebalance back up. A volatility dampener built into the structure. Ryan coined a term. The institutional break, old Bitcoin. Retail FOMO pushed prices higher in feedback loops. More gains equals more hype equals more buying. New Bitcoin. Institutional rebalancing creates natural resistance. More gains equals automatic selling. Physics had changed. Phase 2, the 100,000 test. October 2024, Bitcoin rallied from 70,000 to 85,000 in 3 weeks on election speculation. Old Bitcoin would have blown through 100,000 into euphoric blow-off top. 120, 140,000, vertical. New Bitcoin hit 85,000 and paused. Consolidated. Why? Institutional profit taking at psychological resistance. November. Post-election momentum pushed Bitcoin through. 95,000, 98,000, 100,000. Bitcoin hit 100,000 on a Tuesday afternoon. By Friday, 87,000, minus 13% in 3 days. But here is what did not happen. The crash. Prior cycles, when Bitcoin hit resistance and reversed, it crashed 60 to 70%. Capitulation, panic, blood. This time, 13% pullback, then stabilized. Why? Institutional buy-side absorbed selling. Funds that missed the rally bought the dip. Pension funds making first allocations bought at 90,000. Institutional capital created a floor. Phase 3, the maturation. By mid-2025, Bitcoin's transformation was complete. Bitcoin's 1-year realized volatility dropped below 40%. Lower than Nvidia, lower than Tesla, lower than most volatile assets institutions trade. BlackRock's IBIT held over 800,000 BTC, over 80 billion in assets. Total Bitcoin ETF assets exceeded 120 billion. Bitcoin was officially a normal institutional asset. May 2025. Ryan saw an opportunity. Bitcoin consolidating at 68,000 for 3 weeks, volume drying up. Classic breakout setup he had traded dozens of times in 2020 through 2021. Options were pricing in 15% move over 30 days. Hold Bitcoin, that setup was gold. Buy calls, ride explosion to 80,000. Exit with triple-digit gains. Ryan bought 70,000 strike calls. 30 days to expiration, risked 250,000. Bitcoin moved to 69,500 and stalled. Consolidated for a week, drifted back to 67,000. Ryan watched his calls decay. Time value bleeding. Theta eating him alive. 2 weeks later, Bitcoin at 66,800. Calls worth 80,000. Down 170,000. He closed the position, took the loss. Ryan sat at his desk, hands shaking, staring at the screen. $170,000 gone in 2 weeks. On a trade that would have printed 300% 2 years ago, he opened Bloomberg, typed IBIT, BlackRock's Bitcoin ETF, and there, in the institutional holdings section, he saw something that made his blood run cold. 17 pension funds, 43 insurance companies, 61 university endowments, 214 registered investment advisors, combined holdings, $12.4 billion. These were not traders, these were fiduciaries, people with legal obligation to protect capital. They could not accept 77% drawdowns. They would not chase moonshots. They rebalanced mechanically. They sold rallies. They bought dips. And they controlled enough capital to overpower every retail trader on earth combined. Ryan opened his journal, hand still shaking. Wrote 5 words that changed everything. The game is already over. Not changing. Not evolving. Over. Well, retail lost, and nobody told them. January 2026, Bitcoin conference, Miami. Ryan sat on a panel. Bitcoin and institutional adoption. Bitcoin maximalist. Orange laser eyes on his profile. We did it. Wall Street is buying. Bitcoin ETFs have 120 billion. This is the revolution we fought for. Institutional allocator managing 80 billion. Calm, professional. We are pleased to offer Bitcoin exposure to clients within a diversified multi-asset portfolio framework. Audience member stands, young, confident, probably made money in 2021 and thinks he cracked the code. Question for the institutional investor. You manage 80 billion. How much do you have in Bitcoin? 2% of our multi-asset portfolios, approximately 1.6 billion. And what returns are you targeting? We model Bitcoin as a high volatility alternative asset with expected annualized returns of 30 to 40% over the full market cycle, with drawdown risk managed through position sizing and systematic rebalancing protocols. Wait. The maximalist's face changed. He leaned forward. Wait, 30 to 40%? Bitcoin is going to $1 million. You're leaving 10 times gains on the table. The allocator smiled politely. That would be a remarkable outcome. However, our quantitative model suggests Bitcoin reaching 200,000 to 250,000 over 3 to 5 years is more realistic given current market structure and market capitalization scaling dynamics. The maximalist stood up. You're missing the global adoption curve. When central banks start buying Bitcoin as reserve asset, when pension funds in Japan and Europe allocate, when sovereign wealth funds enter, you are looking at 50 trillion in new demand. Your models assume static demand. They are wrong. The allocator paused, considered. Fair point. Let me show you why that still does not change the math. He pulled up a chart on the screen behind him. Block number 4, 5943, CHARS. Copy central banks globally hold $9.5 trillion in reserves. If they allocated 1% to Bitcoin tomorrow, that is $95 billion. Sounds massive, right? But spread over 5 years of gradual adoption, that is 19 billion annually. BlackRock's IBIT alone brought 30 billion in year 1. The market already absorbed and priced in institutional adoption. The surprise is over. What you are describing is not a new wave. It is the same wave, just later participants. And here is the crucial part. Even if I am wrong, and 50 trillion flows into Bitcoin over 10 years, that is 5 trillion annually. Bitcoin's market cap would need to grow from 2 trillion to 20 trillion. That is 10 times appreciation. But Bitcoin's volatility would compress from 40% to 15%. You know what asset has 15% volatility and generates reliable returns? The S&P 500. Congratulations. Bitcoin became stocks. You get your 10 times. But it takes 10 years, not 18 months. And the journey is boring. The maximalist sat down, silent. Ryan watched the realization spread across his face. The same realization Ryan had 6 months ago staring at Bloomberg. Institutional adoption means lower percentage returns. Not bad returns, normal returns. 30 to 40% annualized is legendary by institutional standards. Better than almost any asset class over long time frames. But for retail traders who remember turning 10,000 into 100,000 in one cycle, it is boring. That night, Ryan met his old friend from retail trading days for drinks. Dude, you're at a fund that trades Bitcoin now. That is sick. Bitcoin to 1 million, right? When are we getting there? Ryan sipped his whiskey. Slowly. Probably never. What? Why? Institutions are buying. Ryan pulled out his phone, showed a chart. Bitcoin gains by cycle. 2012 to 2013, $10 to 1,000, 10,000%. 2015 to 2017, 200 to 20,000, 10,000%. 2018 to 2021, 3,000 to 69,000, 2,200%, 2022 to 2025, 15,000 to 100,000, 545%. See the pattern? Every cycle, lower percentage gains. Yeah, but market cap is bigger, harder to move. Exactly. Now add 120 billion in institutional capital, creating automatic resistance on every rally and automatic support on every dip. What do you get? Friend thought for a moment. Smaller swings, which means smaller percentage gains. Next cycle, I would be shocked if Bitcoin does more than 2 to 3 times, 100,000 to 250,000 over 5 years if everything goes perfectly. That is still amazing returns. It is good, really good by institutional standards. But think about what that means in real terms. You invest $10,000 today. 5 years later, you have 25,000, 15,000 profit. Life-changing? Not unless you were already poor. The people who made true life-changing money did it when Bitcoin went from $100 to $10,000. $1,000 became $100,000. $10,000 became $1 million. Those moves do not happen anymore, not with this market structure. To deliver another 100 times from here, Bitcoin needs to hit $10 million per coin. That is a $210 trillion market cap. That is 10 times all the money that exists on Earth. It is not happening. His friend stared at his beer. So institutions killed the moonshot. Ryan leaned back. Institutions made Bitcoin legitimate. They brought $120 billion, That is more than the GDP of Ukraine. That is 3 times NVIDIA's annual revenue. That is enough money to buy every single Bitcoin mined in 2024 16 times over. They created liquid markets. They built infrastructure. They gave pension funds and endowments and insurance companies a way to allocate. The cost of legitimacy is volatility, and the cost of lower volatility is lower upside. You wanted Wall Street to take Bitcoin seriously? Congratulations. They did. They bought 120 billion. They built entire asset management platforms around it. They created regulated products that grandma can buy in her IRA. But Wall Street does not do moonshots. Wall Street does risk-adjusted returns. And risk-adjusted means capping upside to manage downside. You have to choose. Keep Bitcoin as a degenerate gamble with 10 times potential and 77% crash risk. Or accept Bitcoin as a legitimate asset with 2 to 3 times potential and 30% crash risk. You cannot have both. Retail wanted institutions. Institutions came. And they brought their risk management frameworks with them. His friend was quiet for a long time. Finally spoke. That is kind of depressing. Ryan shook his head. It is evolution. Every revolutionary asset goes through this. Gold used to swing wildly when it first became tradable. Now it is the definition of stability. Tech stocks in the 90s were moonshots. Pets.com, 300% gains in months. Now, tech stocks are in every single retirement portfolio, generating 12% annually. Boring, predictable, profitable. Real estate used to boom and bust violently. Now it is an inflation hedge that compounds at 6% forever. Bitcoin is not dying. Bitcoin is growing up. And growing up means becoming boring and profitable instead of exciting and risky. March 2026. Ryan closed positions for the quarter. Bitcoin at 106,000, up 5% from prior quarter. His fund's Bitcoin allocation, 3.8 billion. Year-to-date return, 31% annualized. So the next time someone tells you Bitcoin to 1 million next year, ask them to show you the math. Where does the 10 trillion in new capital come from? What drives institutional allocations from 2% to 20%? How does volatility not compress further with more capital inflows? What changes the rebalancing dynamics? They cannot answer because the math does not work. Bitcoin will likely continue appreciating. 30 to 40% annually compounds beautifully over decades. 100,000 becomes 750,000 in 20 years at 35% annual returns. That is life-changing money if you hold long enough. But it happens slowly, boringly, predictably. And for institutional finance, predictable is perfect. Because predictable means they can model it. They can risk manage it. They can allocate to it. Congratulations. Bitcoin became investable, which means Bitcoin stopped being a moonshot. Welcome to the new normal. Bitcoin is not dead. Bitcoin is not even wounded. Bitcoin is just not exciting anymore. And in the world of institutional finance, boring and profitable beats exciting and risky every single time. That is called success.